program. Thank you. You have the floor, sir.
Thank you very much, President Mike. I want to say a big thank you to you for pushing on and pushing on us to have this kind of initiative for our members. I want to thank everybody that's already signed on for coming in. And we apologize for the late start. It's not in a character like the president noted, and we'll try and make it up, and we'll ensure that the program is worthwhile. Thank you. So I'll go straight to the presentation now. Are we able to see the slide?
Yes, sir.
Okay, thank you. As said, this is a presentation to talk generally about tax strategy and planning. As you all know, there are two debts we owe in this world: just debt and taxes. Canada runs on a progressive tax system, which implies that for every income you make, the higher the income you make, the more the taxes you are expected to pay. And at the same time, in Canada, the administration of benefits is hinged on the net income amount that we report. And if you are single, it's your own individual net income that matters. And if you are married, the benefits that are assigned in terms of, is it the Canada Child Benefit, is it the Canada Workers Benefit, is it the GST, HST, and a couple of other benefits, they are based on the amount of net income that is declared by the family, not as an individual unit. And so as we go through this training today, we would have an understanding of, because this particular training will talk not only on the Canadian tax system, we're going to also review some aspect of, what are the opportunities inherent in the tax system that we can take advantage of. And I would say something is common amongst our folks. We always wait until the tax season to say, let me file my taxes. But the way it is you shouldn't allow the tax preparer to determine your fate in terms of how much tax am I paying at the end of the year, or how much refund am I going to get. You don't wait. You should have some. I work with a lot of clients, and the kind of client I work with, before the year ends, they give us a call. They ask us to review their tax situation. They look for planning opportunities that they needed to do before the year ends, and they set all those things in place. As it is today, March 1st, I think RRSP window closes March 3rd this year. That's the only window you have for maybe doing any planning. And if that window is closed, the only planning that you can do will be when maybe the experience of the person presenting or filing your tax return to know how do you, because sometimes the tax outcome that happens at the end of the day, it depends on who is preparing your taxes. There's a way medical expense, for example, should be claimed between spouses. There's a way childcare expense should be claimed between spouses. There's a way to split income when you're filing tax return. But if it's done wrongly, that's where you have different refund outcomes depending on the experience of the person that will be preparing your return. But as we go further in this slide, we would have an understanding, an overview of what I've just mentioned briefly. So this is an overview of the topic we'll be looking at today. We'll be reviewing income tax brackets. We understand, I know you have had a lot of things about, I know it's always shared every year by Canada Revenue Agency and also by, every provincial government, the way it works in Canada, there is a different tax. The tax bracket for federal is a little different from the federal tax bracket, and the rate of the marginal tax rate for each tax bracket also differ among provinces and also the federal tax brackets. We'll explain what we mean by tax brackets, marginal tax rates, average tax rate as we go on in the slide. When we leave, hello? Okay. Can you hear me? Can everybody hear me?
Yes, we can. But I guess you
thank
need to move the slides, please. I guess we're still on the first slide.
Oh. Can you see the second slide now?
No, we have tax optimization for strategic advantage.
Okay. I think I would need to reset this. I'm actually not, to be sincere, I'm actually not used to Zoom. Today is my first time. I'm used to using Google Meet for my presentations, and let me check this again. Okay, I think I should be able to. Okay, I think it should work now. Okay, can you see the second slide?
Not yet, please.
Yeah, it's sharing now. Let's see.
Yes, you're sharing. You probably want to move, just click on the next slide.
Yes, I've done that. Can you see it now?
No. And I don't know if other people can see.
I can see it. Is it not the one that has the text optimization for strategic advantage?
We need to move to the second slide.
Yeah.
I don't know why this is not sharing.
If you
Okay, can you see it now?
Yes.
Yes.
Okay, thank you. Thank you. Yeah. Okay, as I said earlier, we'll be reviewing 5 topics mainly. I will quickly go through them. I will ensure as much as possible that we get the details of what we have in each slide, and I'll also give room for Q&A session. But I believe circumstances will be different. We're going to have different questions we want to ask, and so the first slide, we'll be talking about income tax bracket, as said earlier, which differs from province to province, as I mentioned. So by the time I get the second slide, I will talk more on that. Also, we'll be looking at net income reporting and government benefit optimization. We'll also be looking at how we can organize our affairs for tax season and to take maximum advantage of the outcome. For this one is very important because this is the season when we file our tax returns, and like I said, presentation matters. Who is filing for you? Who is reviewing your deduction? Who is reviewing the tax credits that are due, and how is it being presented and reported? Then we'll also be looking at a number of tax planning tips and traps. Then from there, we'll also proceed to understanding tax credits and deduction and their use cases. If you look to my right, you see just a glimpse of the income tax bracket. I'm going to go to that later, but I'll first of all talk about this first slide. When we say tax bracket, the tax bracket just highlights different levels of income. Can we mute I could hear some sound. I'm
sorry, I think it's me.
Okay. Like I said, income tax brackets just highlights different levels and thresholds of income and the tax rate attached to them. The income tax bracket actually has all those tax rates you see attached to. We're going to look at the slide on income tax bracket in the next slide. Those tax rates are actually called marginal tax rates. Those marginal tax rates, that is the tax rate for every additional dollar of income that you make above a particular level of income, you are moving to another marginal tax bracket. And the way it is you hear people talk about tax planning. Tax planning, what is tax planning? Tax planning is just ensuring that you structure your income such that you pay the minimal amount of tax possible within the tax law. Yeah, not evading tax and not reporting your income, but in this instance, you are trying to ensure that even in anything you do, you don't want your income to be above this threshold, and you don't want to be taxed above this marginal tax rate. That's why you see people talk about tax bracket and marginal tax rate. Like I said, it's a reference point for determining that's tax bracket for determining every individual's marginal tax rate. It also gives guides. It's the basis for structuring tax plan, because when marginal tax rate is not the reference point, then what tax planning are you doing? Because you are not, at the end of the day, the income, when you structure, let's say you structure income to be a particular amount, a particular rate is going to be attached to that, multiplied to that income for you to be able to get what the eventual tax that you pay. And also there's also the concept called average tax rates. Like I said earlier, the marginal tax rates, there are specific rates that are attached to every tax bracket. We'll look at the tax bracket in the next slide. But there's something also called average tax rate. Like the way marginal tax rate is, for example, if you are within the second marginal tax bracket, it does not mean that you are paying that second marginal tax bracket for all your income. It means that you have paid the first, the first bracket is like 15%, the second bracket like 20%. So it means that the income that falls within the threshold of the 15% will be taxed at 15%. So any income above that threshold gets taxed at 20%. So that's why the concept of when you're doing tax planning, you're also talking about average tax rate, which talks to effective tax rate. How much tax are you actually paying? For example, the way to explain average tax rate is this. Let's say you earn income from employment, you have pension income, you have dividend income, you have capital gain income, you have self-employment income. All those income are summed up. Your tax at different threshold of income within the marginal tax rate would have been determined. They would have assessed those taxes. So at the end of the day, for example, capital gain only has 50% inclusion rate. What do I mean by that? If you make 100,000 capital gain, the only amount that is taxable is 50%, as according to the law now, just now. There are a couple of changes that are going to come in next year, that they postpone. But for now, it's 50% inclusion rate. So it's only 50,000 that will be subject to tax. So by the time you sum up all the taxes you have paid, divided by that total income from all sources, that's where you have average tax rate. So those two concepts, marginal tax rates, average tax rates, we need to take cognizance of them, because those are you want to do your planning, you want to say, okay, this income, like when client calls me, they'll say, oh, Foley, I don't want to go beyond the third marginal tax bracket. Please, how much income am I going to make this year? They'll try and review it. And if they see that they are going to exceed that marginal tax bracket, what do? They quickly, okay, let me check. Do I have RRSP window to contribute? Is there any opportunity for me to split income with my spouse? So those are kind of small, those are basic level planning that, they can quickly do before the year ends. Or it could be like, oh, I'm running a business and I need an asset to purchase, and I don't want to wait till next year. Let me buy the asset this year so that I can claim that by business, I'm referring to sole proprietorship business. We're going to talk about that as we go on in the slide. So, for example, if you make loss on your sole proprietorship business, you are going to have something they call non-capital loss. That non-capital loss can be applied against your income from other sources to reduce your taxes. So, having said that, If you look at the next box, it talks about the federal and the provincial marginal tax. All these things I'm talking about, when we go to the next slide, we'll see a pictorial view of the income and marginal tax bracket. So that would give us more insight and understanding. So I'm trying, as much as possible, not to be too technical, to break it down to our own understanding. And the essence of this training is that even if you don't use FINT as your consultant, have that, like on the average, most of our clients are Caucasians. Like on the average, when a client is coming to me for their taxes, they have 90% of the answers. They are just looking for 10%. So if you do anything for a client, they are going to be asking you question. Okay, why did you do this way? Why did you do this way? Why did you claim this? So I'm just trying to, we are using this training to be able to empower our own community so that when you go to your accountant, when they do your taxes, you have that information to be able to ask questions. To ask them, why did you do it this way? Why am I not having this deduction? Why didn't you apply it this way? So that, just to empower us to have that information to be able to engage. Thank you. Then, like I said earlier, the provincial tax rate and the federal tax rate, they determine the total and eventual marginal tax bracket that we fall into for all the categories of income that we might be in. And the context of income tax bracket, marginal tax rate, average tax rate, they have application for tax planning. And the way we do our planning is...
Hello, sir. Yep. Do you have the power to mute caller?
Let me see. I think I should.
Yeah, Mr. Dada, if you can also assign probably admin right. If I can do that for you, if you assign admin right so that you're not distracted.
Caller is currently muted. So caller is muted.
I think you can assign it to Adebimpe to be the second.
Yeah, let me see. Okay, let me see. Like today is my first time using Zoom. Like, so I'm used to. I'm trying to look for how to assign admin right here. You want to help me? I want to assign admin rights. Do you know how to do that? Okay.
He has muted himself. Let's go ahead, please.
Okay. Let's just leave it. Let's go. Sorry for the break in transmission. I said when we are referencing marginal tax brackets, average tax rate, marginal tax rate as basis for planning, one of the things we can do, you structure your income to achieve specific marginal tax rate objective. I don't want to exceed this tax rate. Because, it is important that we make money, we do business, we make money, but then we need to pay attention to taxes, because if something is taking 50%, 30%, 40% of your income, you should pay attention to it. How do you work around that legally? So that's the essence of this training. You structure your income to achieve specific marginal tax bracket. You target specific average tax rate. For example, how do you target average tax rate? You can structure such that we'll see the details in the next slide. You can say, okay, I want to make, in Canada also, different income are taxed in different ways. There are specific income classes that have specific tax credits that optimizes the tax that is paid on those income. I will explain it in the next slide through the pictorial view. So when you target those income sources, at the end of the day, the taxes you pay, your after-tax cash flow will be better when you structure your income to meet those specific objectives. And you do it, I would say you do it yourself and also in cohort with your tax advisor. Yeah, the final thing you do when you are doing your tax planning based on income tax bracket to ensure that the desired, for example, I say, okay, I want to make, if I make 100,000 this year, I want to ensure that at least I have 70,000. You can find a way to structure your income such that it is those income types that does not attract too much tax that will form the greater proportion of your income. Okay, now this is an interesting slide, and I love this so much. If you look at this slide, it highlights tax rates and actual for different income types and ranges. Here we have, there's something they call, we have ordinary income. Ordinary income is maybe your T4, your OAS, OD security, your pension, your self-employment income, your other income, maybe your T4E that they give EI kind of income, because it's also taxable. Those set of income are taxed in a specific way based on the rates you have on the marginal tax rate table. On this table you have, if you look to my right, you will see the federal income tax bracket, you will see the provincial income tax side by side. So for the first set, you see the federal, the lowest, within the first threshold, 55,867 or less, taxed at 15%. On the provincial side, 47,937 or less, taxed at 5.06%. So if you are making 47,976, subject to some conditions, you are paying approximately 20.06 tax rate. But there's something interesting in BC. That's why I love this table. In BC, any income you make up to 24,338, there's no tax on it. There's no BC tax on it. You are not taxed on that kind of income. If you look at the table to the left, you see we have so I got this source from E&Y, so it's so interesting. If you look to my left, you see the first set of income. This table has integrated into it because everybody has something they call personal amounts, tax credit. There are a couple of tax credits that they are assigned to all individual taxpayers, which is like 15,705. So if you make 15,705 in Canada, you are paying neither provincial tax or federal tax. So because of that personal amount, which is that tax credit, because definitely income at that level is being taxed at 15%, right? So if it's being taxed at 15% and your tax credit is also 15%, means that tax credit, I don't want to, there's something I'm going to explain the difference between deduction and tax credit in further slide. So that tax credit, what tax credit actually does for you is tax credit offsets every dollar of tax payable. For example, if you have 15,000 tax payable and you have 15,000 tax credit, you will pay no tax because that tax credit will offset that tax payable. So on the first slide, you see 15,000 is non-taxable. So additionally in BC, 24,338, you pay no tax on that income. So that has been, all those tax credit and BC tax reduction credit has been integrated into this marginal tax rate table. So all you see here is, if you look at the percentage rate of taxes, you see there's something they call eligible dividend. Eligible dividend means, in Canada we have eligible dividend, non-eligible dividend. In general, every small business in Canada, if you make 500,000 and below, your tax rate, the corporate tax rate is like, in BC is 11.9, 11.8% that you're paying. And this low tax rate is due to small business deduction. But any corporation that makes anything above that, 500,000, they are taxed at highest tax rate, 38%. So any dividend that is paid from income that the corporation enjoyed tax deduction on, that is called non-eligible dividend. Any income that is above that 500,000 limit, they call it GRIP, General Rate Income Pool. So any dividend that is paid from those income is called eligible dividend. And the way the dividend works in Canada, when you have a dividend income, they mark that dividend income up by a particular percentage, depending on whether it is eligible dividend or non-eligible dividend. For eligible dividend, they marked it up by 38%, which reflects the tax rate the corporation has already suffered on that income. And consequently, they also provide some credits on that eligible dividend. So if you look at this table, because of those credit optimization, if you make a dividend income of up to 55,867 and you're in BC, you are paying no tax. You even have, out of this, this table was listed as 0 because some of the levels of income even have, it's possible for you to even have negative, maybe your tax credit exceed the tax payable on that income. So that tax credit can be used to offset other taxes. So if in a year you decide to say, okay, the income I want to make this year, maybe you have an investment in public corporation. Public corporation generally, they make millions of dollars. So any dividend they pay, definitely going to be eligible dividend. So if you make eligible dividend within the threshold of 55,867, you are paying no tax on that up to this level. And you can also see, and one thing if you look at the marginal tax rate for normal income, dividend, other than eligible dividend and capital gain, you see that the marginal tax rate on general income is even higher compared to the one on eligible dividend, the one on other eligible dividend, and the one on capital gain. And the reason capital gain looks like 50% of others is because, like I said earlier, currently it's only 50% of capital gain that are subject to income inclusion that will be taxed. By next year, recently there was a new pronouncement that any dividend above 250,000 for individual, we have 66% inclusion rate. And any dividend made inside the corporation from 0 and above is 66% inclusion rate. And it was serious arguments before they prorogued the parliament, and it's been suspended until January 1st, 2026. And maybe if the political landscape changes, another party comes in, that because other parties are saying they don't want that to take off. So let's see how it goes. So this table presents to you, different income types, how much tax you are expected to. So every year it should be conversant with how much am I making? How much is my spouse making? And how do we manage our taxes? Because it's something like, if you are making 100K and you want to make away with 40,000 every year and you're okay with that, that's fine. But some people want to say, okay, what planning can I put in place to ensure that I pay the minimum amount of tax as possible, and to ensure that, within the law as well, I'm also able to harness some benefits. So I'll ask a question quickly. Do we have an understanding of this explanation, or do we have quick questions on this? Hello?
Yeah, my name is Mike. I just wanted to say that the presentation sometimes could be very technical. I think the underlining fact is that if at the end of the tax application, as it were, we are able to earn some money, I think that would be more interesting for us, and I'm sure you're going to get there. All right,
We'll get it, sure.
All right. Thank you so much.
Sure. Yeah. Like Mr. Mike, President Mike said, I would say it is not, we need to have sometimes you do tax for people, they say, I don't have refund, or my friend got refund, I didn't get refund. There are a couple of things that determine whether you're going to get refund or not. Apart from, this particular slide just talking about you are a high income earner, you have the power to vary your different sources of income, you have the power to do income splitting. These are the opportunities for you to tax plan to ensure that you don't go beyond the particular tax rate. So let's go to the next slide. This next slide talks about net income reporting and benefit optimization. What do I mean by that? In tax balance, there's something we call above the line item and below the line item. The above the line item, those are your, when you are preparing taxes anywhere in the world, the first thing that comes first is your income. How much did you make? Before the government determines that how much of this income will I tax. So your net income constitutes your total income from what sources. It could be dividend, it could be capital gain, it could be pension, it could be old age security, it could be GIS, it could be self-employment income, it could be foreign income. Now, what do you do? Like I mentioned earlier, the benefit that the government administers gives to everybody that qualifies for that benefit, it's based on net income that individuals or families make. If you are married, it's going to be income of your spouse and you together. And some of the benefits that the common ones that we are aware of is Canada Child Benefits, which also incorporate the provincial component of that tax benefit, GST HSC credits, Canada Workers Benefits, and a host of other tax credits. Then why is this particular topic very important? Net income reporting is also an important point that we need to pay attention to. I'll give an instance. There are a couple of income that are always marked up. That's where you have to, for high income earners, for example, if you make a particular set of income, you don't need to be thinking about benefits. Like for me, I don't like planning benefit for some people do it. I have some multi-millionaires that still declare poverty level income. It's their choice. But for me, as a principle and ethics, well, it's up to them that they just leave the income in the corporation and they only report what they want and they will still be able to collect benefit. So this net income, we need to pay attention to it. For families, if you have children, one of your primary goal is to ensure that you fall within, and you don't have too much income, you fall within that net income threshold so that you don't lose, because there's a particular threshold amount of Canada Child Benefit that maximum that a person with one kid, person with 2 kids, 3 and 4 plus kids can get. Now, if your net income goes above a particular threshold, there's something they call clawback. It will reduce. By next year, once you report that net income, Canada Child Benefit, for example, is reported between July current year to June next year. And the let's say July 2025 to June 2026 is based on income reporting of January to December 2024. So any net income you earn between 2024 will determine what benefit comes to your family this current year by July. Now, how do you optimize your net income? For families, and when you're managing like your income and you're also optimizing benefits as part of the cash flow for your planning, you ensure that your net income is brought down as much as possible. Then how do you do that? First thing you do, I will say this, in Canada currently, there's a particular window now for first time. This training actually covers everybody. Like maybe a new immigrant that has not bought a house yet. RRSP, FHSA, those are your key instruments. Currently, home buyers plan for RRSP. It means that if you contribute money to RRSP, you get a deduction against your income. Potentially, you get tax refund back, and you can borrow up to 120,000 as a family, 120,000 from the RRSP towards your mortgage payment. Again, you can contribute to FHSA, that's 8,000 per year, to also bring down your net income. So, it's a win-win. You contribute to RRSP, you get tax, your net income reduces, optimizes your benefits that government will give that will come to you. At the same time, you get a tax refund that you can invest in something else, and you can borrow money from your RRSP. They call it home buyers plan to get a mortgage. It's win-win. So it's sometimes, if you look at the way, if I'm able to share them, I will share a model maybe later before we finish. You see how much, child benefit that you lose if your net income goes beyond a particular level. So we need to pay attention to that as well. And what are the planning strategies around net income? You structure, like I said earlier, you structure your earnings to ensure that your net income stays within a particular threshold. How do you do that? Your RRSP deduction, your union dues, your FHSA, and any deduction that are available for you to to offset that net income, to reduce it as much as possible, to fall within that threshold of benefits that would come to you. Build and apply available deductions and income for income splitting. It does not apply to net income anyways, because income splitting will just optimize taxes for both spouses. That applies to pension and roll forward and deferrals. What do I mean by that? For example, if you own a corporation, like maybe you want to pull out dividend or salary, you can say, oh, I don't want to exceed this net income. Let me wait till next year to claim this income, so that I can reduce my net income. It's possible. You can say, let's say for corporation, that's why it's very important to optimize to ensure that your year-end falls. If your year-end falls within the very good number of very good session of the month of the year, there are a couple of planning on income around how you can structure your income to ensure that you spread income across 2 years, and be able to optimize your net income. Yeah, so that I already talked about income splitting within corporate structure. For that, if you and you own a corporation and you and your spouse, you work there, if you want to give money to your spouse and you make sure that you are documenting, CRA is all about documentation. Make sure you are documenting hours that people are working. You justify. You don't just allocate earnings to people. You don't just pay income at random.
2 lines, 2 here and 2 here. 2.
Even if your children are working in your company, make sure that those work hours are being documented in case because there's nothing, what we do is to prepare return and send to CRA. They can pick anything at any time and do audit. But there are opportunities to income split. But don't do dividend. I'm going to get to that later. But when it comes to payroll, if you have a kid that works in your business and you document those work and those are legitimate work, you can pay income to your children. It's allowed, it's allowable, and there will be no issues with it. As long as you have the documentation that proves that they've done the work and they earn the wage. Then I also talk about non-capital loss. What do I mean by non-capital loss? I think I mentioned it earlier. If you are, sometimes this particular item is very important in, some people say, what time should I incorporate? It depends. If you are already earning very high income, I would say immediately, once you are starting a business, you're already earning a very high income and the business is already sort of profitable, you can incorporate almost immediately so that those income does not report also in your personal income. And if you have a business that maybe for the startup, you are going to be spending you are going to be incurring a little capital expense, it's better for you to just still leave it as a sole prop, incur those capital expenses. You have low income, you have no expenses. Any loss that you realize from your personal self-employment income, you can deduct that income against your other sources of income, and you can optimize your tax refund from that, and your net income also goes down from there. So that's non-capital loss. And then there's also the context of it's not so common, but it exists, non-taxable and non-reportable income. Everybody just talk about tax in Canada and all, but there are specific income that are non-taxable. For example, if you are working at a remote work site, or you are working at a site that is not your primary place of employment, normally, maybe your employer sent you somewhere to go and work in a location, and then you have to incur some expenses, they can give you something they call leave-out allowance. Leave-out allowance is non-taxable. They can give you leave-out allowance that covers what's it called? Your meals, the specific rates, CRA guide on that. It covers your meals, incidental expenses, the use of your motor vehicle for business and all. So those allowances, like all you need to do, just fill something they call TD4 form with your employer. They fill it, they document it. If they give you, they can give you $30,000, as part of your LOA, and that money is non-taxable. It will not even report on your T4. But there are specific rules that guide that. But if you have an accountant that I've seen some clients that came to us that the former accountant was not, they were not taking cognizance of that LOA. And when they came to us, we were able to identify those LOAs, and we were able to plan for them to get those LOA. Some even like we currently have one client now. They are doing work in one region in one of the eastern provinces. Like they're doing the construction work there, and they have so many staff, and they have to pay LOA, to each of those workers. So those LOAs are non-taxable. So it doesn't report on net income or nothing. They get it. Some of them 40,000, 30,000, 50,000 LOA. Because so the one they get for wage is different. So there are specific rules on leave-out allowance. If you are working in, but you need to discuss the situation. It could be complex, but we can always analyze to see if your employment, your contract qualifies to be able to do LOA to get non-taxable income. Like as mentioned earlier in previous slide, some of the income tax benefits are Canada workers benefits, Canada child benefits, GST and HST credit. There's something about Canada workers benefit. Sometimes people will say, oh, make sure that you claim all deduction, all expenses. But if you don't fall within the right income threshold, you will lose this Canada workers benefit. So sometimes claiming an expense might even be a problem. Like I would say, you are compelled by the law to report all your income, but you are not, but expense claim is discretionary. I've seen some planning that we'll be doing when you are doing tax return that we just see a client that, oh, they made this particular income. Sometimes you want to maximize the calendar workers benefit is like for single is like 1,500, for married is 2,500. Just do the planning such that they will be able to get that benefit. And this calendar workers benefit is it's a refundable tax. You get even if you don't have taxes to use against it, they will refund it to you. You get it. So it's also based on your net income as well. Yeah. This first slide, we'll be talking about general, this is tax season, and we want to ensure that we are organized. And I just felt this is important, to guide our members. When you are going to your accountant, if you are not going to be using us, if you get your work papers well organized enough, and you get more knowledge about all these credits. One, if you organize for me, if a client sends me a disorganized work paper, my staff will work to organize those papers, and the client will pay for the house. So if you can get everything together, I have some clients that they just get everything organized, and once they come, everything gets done fast, so we don't need to charge them. So we are also using this also to educate our members so that when they, prepare all their work papers, they know what can be claimed, they know what cannot be claimed, and they know how to put everything together. I would say tax circumstance differ from person to person. What do I mean by that? If you are married, you have kids, your circumstances are different. If you have self-employment income, your circumstances are different. If you have employment expense, circumstances are different. It all differs on what do you have. But the important thing is you need to be aware that can I actually claim all these things based on your, taxes is based on your activities. What have I done this year? What income have I made? What transfers have I made? What expenses have I incurred? Are these expenses deductible or non-deductible? We need to be able to work papers planning. You have several work papers. It ranges from your tax slip itself, there are different slips, investment slip. Let me just go one by one. For medical expense can always be optimized. Like I said earlier, presentation matters in tax filing. If somebody is not so knowledgeable, they are filing for you, they might just be doing nonsense, and it doesn't really add value, and it's a disadvantage. For example, medical, if you or your spouse and kids have medical, they can claim it on the best thing to claim medical is to claim it on the lower income spouse return. Because for medical, there are specific triggers, 3% of net income or a particular amount that reduces the medical that you can claim. So if you use higher income spouse to claim your medical, what will be available for claiming will be minimal compared to if it's properly done to claim it on the side that it should be. And on tax slips, there are different tax slips, and they come at different times. By now, I expect all the T4, T5, and a host of others to be available on CRA sites. But we also need to be very careful that we have all the T slips complete before we file. For example, some of the investment and dividend slips, they don't come until April. And I've seen situations where people will just go and rush and because I want to get refund and you file before time. So when those income now come, CRA will charge you penalty for under disclosed income and the interest applicable. So it's always better to wait to ensure that you contact your banker to say, oh, please give me all my investment package before I take it to my accountant to do my taxes. So we need to take cognizance of those slips. There are mistakes people make on slips. Let's ensure that we get everything together. We ensure that we have all the slips. You ask the banking institution for all your non-registered investments, interest, and dividend, that you have everything in place before you send to the accountant. And also, childcare expenses is also claimable your tax return. And for that, it's also the lower income spouse that would claim the childcare expense. It could be the money you pay to private school is not deductible, actually, but there are some private schools that allows if it's not hours related to instruction, maybe just to take care of the kid for some hours, there are a couple of childcare expenses that can be claimed within subject to some limits. And if your kids go to a particular camp, there's a specific number of weeks that they must spend at that camp to make that amount. It's not every childcare expense. But daycare expense generally before they start school, those are deductible, and a couple of other things. And also if you move from a place to another, and that movement, it's like you move 40 kilometers. Let's say you were living at location A before, and you now move to location B. So that location B is now closer to your work by 40 kilometers. There are a couple of expenses you can claim during your move, including the travel, the meals per day, the temporary rental, hotel accommodation, and all. There are a couple of things within the moving expense schedule that can be claimed too. So you take cognizance of that. And if you are using your home for business, we need to be careful as well. Fine, you can claim, based on the workspace that you are using to work. You can claim some of supplies, you can claim hydro, you can claim other utility bills, But if you have a primary residence, ensure that the percentage is not too extreme so that it doesn't affect your principal resident exemption. Also, vehicle expense. This is an expense that CRA is really doing a lot of audit and review on. We need to be very careful when you are claiming vehicle expense. Ensure that you have your T2200 filled and completed by the employer, and what's it called again? As part of the vehicle expense as well, ensure that you have the vehicle log. There must be a log where you have this. If you are traveling from your work, from home to work, it's not deductible. But if you are traveling from client to client site, office, you can deduct those distance. So you have to be putting log. I went to meet this client. It has to be documented. But if you can file it, there's no problem. But if you file it, they pick it for audit and it doesn't meet all the requirements, they are going to deny it and you'll be paying the penalties and taxes applicable. And also, if you have self-employment income and expense and you are within the that you have incurred during 2024, it's too late to do planning now. You can also include that and ask for the statement of employment income and expense and put all your items there. And donation, I think up to it closed yesterday. Donation up to 20th of February is still deductible based on the new regulation they did this year. Only for this year because of the Canada post strike. So if you have donation, it's also part of the thing. I know we know all this just to remind us, like I said earlier, employment expense, it could vary between, you could buy tools for your employer, use your vehicle for the employer, you could use your home for the employer. So as long as the T2200 is signed, and you are going to claim, like I'm repeating again, you are going to claim vehicle expense as part of employment expense approved by the employer on T2200, ensure that you have log to back those expenses. And if you don't have the log, to be a problem. So tax planning tips and traps. As the tax laws are there are also so many opportunities for planning. There are only limited opportunities now. The only planning you do when your accountant is filing for 2024 is just presentation and knowing how to claim and optimize your tax situation. I said, it is time and situation specific. It depends, when you want to do your planning. There are different transactions that we are not even aware of that they are taxable events or it causes a problem. For example, if you are using a home as a principal primary residence and you convert that home to full rental, it's a taxable event. There are specific elections you have to file. If you don't know, you will make a mistake, you just move, you leave it. And it will cause problem in the future. But there are specific elections you can file. For example, if you are living in a house and you are moving to another house, you live in a particular residence, you are moving to another house. If you move to that other house, you can actually still file election. Even though you have rented the old house that you left, you can file an election to maintain that house that you left as your principal residence for additional 4 years, even while that house is still on rent. There are special elections that must be filed. There are timelines for filing those elections. If those timelines close, you will not be able to file those elections again. So that's why we need to, sometimes, it's good, some say they are doing their taxes themselves, but sometimes you need to talk to people that have the knowledge. And the good thing is, any tax filing obligation, cost that you incur this year, is deductible from your tax return next year. So why wouldn't you give it to experts to do for you? And when it comes to planning, Some opportunities are actually traps, right? So as we go through this slide, we'll know. So, we need to be able to recognize. I get my client call me, oh, Foley, I want to do this. Oh, okay, don't do it that way. Do it this way. Do it this way. They will ask questions before they do something. So I think it was last year, one client, there's something they call Section 85 rollover, which is tax deferred rollover of assets from yourself to the corporation. For example, if you move assets from yourself to the corporation, it's taxable event. Pay GST, you pay PST, and you do disposition. That means any capital gain on that asset, you are going to pay it immediately. But there are opportunities for you to review the situation and do specific schedule and file an election that you can now move it tax deferred. But there are ways to do it. So these clients went to a lawyer. Like I'll say it, all lawyers are not tax specialists. Some of them, they don't know anything about tax. So the lawyer did Section 85 rollover agreements. You now came to us, oh, Foley, you have done. I'm like, why would we do Section 85? Because the thing you do first is that you need to review your balance sheet, your asset situation. What is the tax and depreciable value of this asset? We need to look at what class of asset is this, what is the elected amount. We prepare a schedule. We allocate shares before we go to lawyer. Accountant must do that first. But the client went to do it and it caused a problem. So he wanted to be fast to do those planning, but it was a trap because he didn't do it rightly. So that's why we ensure that we go to the right people, we ask questions, before we do any transaction. Yeah, so, some of the tax events, it covers transfers. For example, it's possible for you to transfer. For example, if you have a spouse that has a capital gain of 100,000 and she wants to sell the share, wants to realize it, and you have an unrealized loss, you have a share that has lost money, and maybe the value has gone down, there's a way within specific limits, you can transfer that at fair market value, you transfer that asset to your spouse. And there's a particular time limit, they call it, there are two rules there, attribution rules and superficial loss rule. There's a way, that superficial loss rule is actually is a punitive tax rule, but you can use it for planning to be able to transfer asset to your spouse. But if you are not aware, you're uninitiated, if you do it wrongly, and if you're going to do that kind of transaction, you ensure that your spouse actually pays for that stock at fair market value. And you ensure that your spouse holds that security for at least 30 days after you transfer it, before she now sells it. So that would enable, the adjusted cost base. Sorry, this is too technical. It will enable, the share that she bought for her to be able to realize the loss and offset it against the gain she has. So don't let me go to so I think I left the slide. So, so that's for transfer. Also, if you want to give something to your kid, you have to also be very careful. If you transfer assets, you love your kid, you transfer asset that has unrealized gain already on it, you transfer it to your kid at lower than fair market value. It's going to lead to double tax jeopardy. So you need to talk to your accountant to ask questions before you do transfer. Even when you are doing, we also do estate planning as well. When you are doing estate planning, you want to do transfer, you need to talk to the right people to ensure that when you are doing transfer, you ask the right questions. Also, when you are doing disposition, when you are selling assets, also is a taxable event as well. There are specific way you do the disposition. Are you disposing? Are you transferring to your spouse? Are you transferring to your corporation? There are specific things that we need to do to take. So, the importance of this slide is just for us to know that, tax planning is bigger than this. I'm just trying to bring the one that I think can apply to us. It's bigger, it's far bigger. There are planning that has to do with trust, with reorganization and all. So it's beyond the scope of this presentation, but I'll just try and stay within the limit of the item I think can immediately apply to us. And also, even when you are exiting, exit means two things. When you are leaving Canada, it has tax implication because every asset that you own, of course, because, okay, the way it is, if you are a new immigrant, once you're coming in, you are meant to disclose all the assets you own everywhere in the world. You're not paying tax on them, don't get me wrong. You are going to disclose those assets at their fair market value. You know them, you have a schedule for it. So when you are leaving Canada and those assets have increased in value, there will be deemed disposition of those assets, and there are specific timeline you need to do your tax return and send the relevant tax to Canada Revenue Agency within that timeline. Another event that, when you exit is when somebody dies. I do a lot of date of death taxes and planning for postmortem. And I see sometimes, some people just die and they put their family in jeopardy. They don't have any plan, no life insurance, no will, no executor. And in that way, and if the person is now unfortunate, the person now has a second marriage to another person, the government would structure how those assets will be transferred, not him. He will not, then also all the windows available within the tax window, they will not be able to take advantage of it. So that's why we need to, talk to our accountants, think planning, look at our tax situation, review everything, and discuss and find out what we need to do at different point in time. I said, tax planning, it requires thoughtful planning before execution. When you want to execute anything, when you're transferring assets, when you're selling assets, when you're moving, when you're doing things, you need to be, think planning. What am I doing? What I have a lot of my clients, they call us, they ask questions. I want to do this. I want to sell this thing to my son. I want to sell this. Even when you want to sell shares of a corporation, everything requires planning. But you are free to do it anyhow you want. But the tax man would get their tax from you, and they would make sure that they punish you for not considering what you should have done. The same thing with tax planning. Going back to the first slide, you plan on your marginal tax rate, your income structure, and your deferral. When you're doing planning, you think about it. Consult and ask questions for clarity. Maximize deduction and tax credit. Consider if you are able to, if you have income, maybe if you want to do investment, make sure that you and your wife invest together, your spouse invest together, so that you can have opportunity to split income. And if you own a corporation, I would say it's one of the biggest structure to do tax planning is when you own a corporation. It's so beautiful. Like, they will only tax what has been taken out, right? If you are within the right income tax bracket, the corporate structure is one of the best income planning and optimization tool that you can, if you are working in an employment, there's a limit. The employer will take your tax immediately as you are taking the money. But within corporate structure, there are multiple planning that you can do that work to your advantage. Part of the planning you do loss planning. Like, you can carry back, roll forward your loss, distinguish between capital and non-capital loss and all. Another thing I also try to talk about is also compensation planning, for entrepreneurs. Should I take on salary? Should I take on dividend? It also requires planning. Some people say just take dividend, it requires planning. And it's also situation specific. What are we talking about? What is the circumstances of this individual? Them and the spouse. We need to, take cognizance of those. There are so many things involved. If you go online, people write different things, but there's no blanket for tax. There's no blanket advice for anybody. It depends on the situation of that person before you can say, oh, this person should be taking salary. Some will say, okay, I'm taking salary because of EI and because of CPP and pension and all. But then there are other planning structures available around dividend as well. Benefit planning. With respect to your marginal, like I said before, marginal and effective tax rate and income splitting. You have to plan your benefits. What benefit are you harnessing? Like, if you own a corporation, how do you want to bring out money from your corporation to ensure that you stay within the right average and marginal tax rate and you're not paying more than what you should pay? And if you have opportunity to split, if you don't need the money, why are you taking it out? Leave it there, let it go. Pull it out when you want to pull it out. However, outside the scope of this course, there are also some punitive rules around doing investment in corporation, but it gets to some threshold before they apply. So if you are still within, you are making 500,000 income and you still have, you are not making 150K in maybe passive income, because there are a couple of rules on passive income. Okay, I need to talk about this. I thought it was on the other slide. A lot of things that people talk about, they will say, oh, go and incorporate. Then when you incorporate, be working. For example, if you want to work with government, they say go and incorporate so that you can be working for the government and they will pay the money to your corporation instead of you. But that's wrong. That's a very serious trap in planning. And there's something they call personal service business in Canada. Personal service business essentially means corporate structures that are incorporated and they are seen as incorporated employee. You are seen as though that relationship is supposed to be employer-employer relationship, but because of you want to avoid paying the personal tax rate, you now want to set up a corporation. In fact, in the tax program, you have to pick that. If that is the nature of the corporation, you have to pick it. And for corporate personal service business, the tax rate is 45%. It's positive. It's 45% tax rate. So if you do that kind of structure, but there is a way to work around that structure. Even if you have that kind of structure, there's a workaround. Like there's no tax situation that doesn't have a workaround. You can always salvage some situation. Like if you have a personal service business and you are doing work for other arm's length individuals, you are able to and maybe the income from those arm's length individual is also more than what you are making from that one, from that incorporated employee structure. We can have a work around that as well, and so many other rules that we can work around. And also, the common thing people do also, they say, oh, I want to buy a house in the corporation. It may be good, but it's also a trap. There's something they call specified investment business. That tax, for example, if you make rental income in a corporation and you don't have 5 full-time employees, you are going to be paying 50.67% provincial and federal tax rate on that income. But along that rules, there are times that it is actually okay, tax optimal for you to do that. But if it's not, just make sure you talk to your accountant before doing that. So for me, if you don't have, maybe you have the fund and you want to invest, you want to have 10 corporations and you're going to get employees, and you have associated corporation structure, we can do an advice and look at the structure and advise you to do that. But if it's not a structure to, you're not running from anything, you're getting into a trap. And there's something also called TOSI. TOSI means tax on split income. If you own a corporation, you put your underage children as shareholder and start giving them dividend. There's a positive tax rate on that as well. It's not something that is allowed, except there's some exemption, but for under, they have those rules around under 18, under 24, above 24. So there are tax rules on that. So it's not even I would say it's not something that we should, not a planning. I know these are like common planning structure that we want to do that, I need to let you know there are a couple of traps that are there. And also for our elders, if you are an elder, you are earning old age security, you need to also be careful of, if you are also earning additional income, if your income goes above a particular limit threshold, that old age security they're giving you, it will be clawed back. So I think now is any amount above 90,978, any amount above that is clawed back at 15%. They take the money back from you until they claw back the entire old age security. So if you have opportunity to split those income so that you don't go above that threshold, so it will enable you to keep your old age security with you. There are a couple of other planning, but I just said to limit the scope of the training to these, because these are like common things that we do. Another thing I want to also mention, because I see a couple of people, they put their homes on Airbnb. They put their homes on Airbnb and it goes above, like if you put your home on Airbnb and it is within a particular threshold, like maybe 20% of your space, you can still hide within a structure. That means not significant components of your home. But by the time but it's subject to some issues. By the time you claim depreciation on those rental income, and you also modify the house for rental, you have caused a problem. What you have done essentially is that you have converted your principal residence to a commercial property. So when you sell that house, you are going to pay GST on that disposition. And you have ignited a change in use rule that you should have filed to CRA. So those are issues that we need to consider when we are. So we should ask my clients. They ask me question: what do I do before I do this? Say, oh no, don't do it this way. Do it that way. Take cognizance of these rules. Don't just do things on your own. Fine, you can if you still don't have any maybe you have only one T4 and your income is very low and you still want to be doing it. But by the time your circumstances start changing, you buy a house, you get married, investments, you need to be using experts for your tax situation. And so I'll be looking at, this just talks about sorry for that distraction. This just talks about understanding tax credit and deduction and their use cases. I said earlier, tax credits are below the line items. Tax deduction are above the line item. What do I mean? Your deduction, like RSP, FHSA, union dues, and a host of other deduction items, they are applied against your net income. So those deduction reduces your net income and enables you to maximize or optimize your benefits. It could be GST, Canada Workers Benefits, and Canada Child Benefits. So those deduction, that's what they do. Deduction reduces your income that is subject to tax. While tax credits, there are two types. There is non-refundable. The non-refundable tax credits, all they just do is the government gives you opportunity to apply those credits to reduce every dollar of income subject to the limit of that tax credit. For example, your medical expense subject to some limitations, what's it called, donation, tax credit, personal amount, spousal amount, and a host of other credits. So what government does is you sum up what those credits are together and multiply by 15%. So that's the credit that you have at the end of the day. So the sum of that product, that means the multiplication of the credits amount and the rates against that every dollar of income that you make will give you a reduced tax rate. And the beauty of the refundable tax credit like Canada Workers Benefit is such that even though you don't have tax, for example, before I go into that, if you have credit that is so much, there are some credit that you can actually defer. You don't need to use and waste the credit. If you have tuition credit and you have donation and you don't want to use it that year, you are at liberty to postpone or defer those credits to future years. And you're also at liberty to waste it. So if somebody is doing your tax return, they don't know anything, and if you have wasted it, you cannot go back and revise your return again because the CRA will not allow that. So for example, your donation, you can say, you can carry your donation 5 years. You can put it on your tax return, but carry it forward. You can carry your medical expense to some limits. You can use, if you are envisaging that you're going to be spending more medical expense at a point in the year, you can start accumulating your medical expense, let's say from November, from maybe July to June of the next year to maximize your credits so that you don't use it in that year. Your donation, you can carry forward. Your tuition, you can carry forward. And a host of other credit you can carry forward. But if a wrong person undoes your return, they will use it and they will waste that credit. So it won't be useful for you. So those are important distinction between your tax credits and your tax deduction items that are available for use. So this just highlights some of the, from the credit amount that, that we have. So these are already multiplied by the absolute credit figure to show you what credits would amount to at the end of the day. So there are always provincial component and federal component of every credit. You have the basic personal amount. So what this means is, even though you have these credits, if you don't have tax you don't have tax payable to offset them, they are wasted. And the only one, subject to a few amounts, you can carry forward your medical up to an amount, you can carry forward your donation, you can carry forward your tuition credits and a host of other ones. But most of the non-refundable tax credits, they are wasted in that year. So once you don't have income, sometimes we tell you, oh, some people have tuition. Like for students, for example, some of the students have done, always in the first year they do schooling, they don't have much income. So we always carry forward to them. So once they are not filing the next year, they're able to maximize their deduction, based on the tuition amount they've paid. And so I hope we've been able to, within the limit of the time we have, to just discuss. But like there are still a couple of trainings we'll still be, bringing on board, beyond this, but we just felt this was based on President's request that we should do this for the community. This was important for us to just not just for 2024, but to just plan for the coming year. And I'll say thank you, and it's now time for question and answers. Hello.
Thank you very much, sir, for your very wonderful presentation. Once again, my name is Mike. I really appreciate the time you have taken to do this. Because of my background and situation here, I will not be able to speak for long. For some of us, my own question would be that if I have a stable income, do I still need to incorporate other sources of income into my current filing? And what are the possibilities that I can get a return after, probably if you file my taxes for me in the future?
Yeah, thank you very much for that question. That question is not so clear, but I would say you already have stable income, and if you have other sources of income, I would say it also depends. You can either, if that source of income that you have, let's say self-employment income, and you are going to be incurring some capital expenses, some purchases at the beginning, and maybe expenses will rise faster than income. It's better for you to operate that as a sole prop, so that any loss you make on that business, it will use to offset your regular income, so that you can get refund to maximize. However, if income comes faster than expenses, maybe you are starting a business and income is more than expenses, immediately I would suggest, depending on threshold of income you have, I would suggest just incorporate the business, let that money grow in the corporation before. And again, you're getting two things. The corporate tax rate is 12%, so you are getting better after tax cash flow in the corporation. Until you pull that money out, you won't be taxed on it. So you are saving a lot of money. At the same time, you're also maximizing benefit on the personal side, so that additional income is not added to your already stable and medium to high income, and you don't incur higher taxes, and you don't push yourself to a disadvantaged tax bracket.
What from here?
Awesome. Thanks, Mr. Dada. We have a question in the chat box. I'll probably read it out for you so that.
Okay, thank you.
And Joy said, for someone who worked in the Canadian Armed Force Reserve, what tax document do they require when filing that tax?
They just need their T4 and all the deduction. The same armed forces have the same. They have the same, just like individual taxes. So they depending on the location. If you are abroad, there are specific benefits that applies. But we need to review they need to submit their T4 or employment income, and all if they have medicals, if they have if they have other benefits would have been reported on their T4. It's just the same basic tax documents that they would submit: medical, donation, T4, and what have you. And if they have other sources of income, which I doubt, if they do, they also submit that one as part of it.
Awesome. Thanks for that one. And I guess there's another one. They said, which section do we categorize taxes paid on flights? Can we claim them also?
Taxes paid on flight, it depends. If your flying is for business purpose, if you're let's say the flight, if you are doing the business and you have to go and see a client in, let's say, Ontario or anywhere, so that flight cost is deductible. But if you have a flight if you have a flight for what's it called, for just travel, on your own, you are going on holiday. So I will qualify it. If you live in Northern BC, travel in Northern BC, subject to some limit, is allowable for deduction. There's a travel deduction in Northern BC. So I'm not going to generalize. If you are in Northern BC, you go on holiday, there are locations, they are within the Northern travel claim, you can claim those credits. But if you are here, you can't claim those. You are not qualified. You are not within the area that can claim travel. But if that travel is for business purpose, like maybe you are doing self-employment business and you travel, you can claim that as a deduction. And also, if you incur those travel expense on behalf of employment expense and your employer never reimbursed you, you can claim that against your employment income as well. So it depends on the situation of the individual.
Thank you. I think I have one in the private chat. It says, if I live in an employer provided accommodation, do I need to file these taxes as well?
Okay. That's very interesting. An employer provided accommodation, I believe it would have been included. It is up to the employer. They must have included that as a taxable benefit. It will have showed on the T4. There's a column they'll put on the T4 box 14 will have all the employment income. There's a box they put other benefits. So you are living in accommodation, you are not paying the rent, they are incurring the maybe utility and everything. So the employer will value all those benefits that have been given to you free of charge, and they'll put in other employment expense. However, if you are living within, if you are doing that employment product accommodation in a prescribed zone or in a location that is outside what's called outside your place of primary employment, maybe they just have a contract, like earlier I talked about LOA. It's possible for that amount not to be included in your income if you are within that zone. But if you are within a zone of, you are close to your primary place of employment, it's not as if it's not a temporary place, or it's not a temporary accommodation in a contract for a specific project. That employer will include that the value of the benefit for you using that house in your tax return. And also, even if your employer gives you a motor vehicle, that employer bought the vehicle and they gave you to use, it's taxable benefits for the personal use component of what's it called, that use of vehicle. And also, even for people that use, just for you to be aware, if you accumulate travel credit based on employment, and you are using those credit personally, it is taxable benefits as well.
Thank you.
Yeah.
Thank you. We have Irene Okorie. Irene, you have the floor, please. You can release your microphone and speak.
Okay, I actually wanted to ask if I can, how to reach him after this meeting, just to have a private chat with him.
Yeah, possible. Bimpe, can you help me with that? I sent you a link to put in the chat. You can put your details in that. We have a Bimpe, is it in the chat?
Yes, it is. I'll repost right now.
Yeah, repost it so that she can fill it. You can fill a document there. It will have your name, address, and email. Then we can have a chat, definitely.
Okay.
Thank you. Dayo Tinkerman has just reposted it. Thank you, Dayo.
Thank you.
And yeah, if I could just add to that, you could also visit the FinTax website. We'll post that right away. There are lots of information on that website that is so useful, and the contact details are also listed. We have offices in Victoria, we have in Dawson Creek, we have in Vancouver and other parts of BC. I'll try to share the website here so that we can all have it and then we can all review.
Thank you. Thank you.
You're welcome. Do we have any other participant with questions? It's question time. I think we have a few minutes of Mr. Dada's time. Questions, comments, yeah.
My name still remains Mike. Thank you, Bimpe and Dada, for this wonderful opportunity to listen to a perspective from our own. A lot of our people probably, like I said, are also engaged in some other activities and not here. I want to find out what do our community, in terms of engaging your services, will be able to narrow down if we eventually get you to do our taxes. Is this something you want to do personally, or you want us to send it across to you, or you want to just say it now?
Yeah, we can say it. As I think for the community, for any client that will be using us, usually our tax consulting cost, we charge per hour for tax consulting cost, and we are going to give them free 30 minutes consulting. And also we also be applying 10% discount on our fee. And another thing we'll be doing is for anybody that has used another provider in the past, And we are also willing to discount any fee they've paid last year by 10 to 15%, coming from, if they're coming as members of NCABC as a community. Yeah. And also, we'll be coming up with, other trainings. We'll be, providing some other trainings on estate planning, and that will be our next. I think we'll also be doing other ones on, corporate structure and planning. As the year runs by, based on the president's request, we would have that in place too. So they'll also be able to benefit from that as well.
Thank you.
Yeah.
Kelvin is asking, is FinTax in Kamloops?
The thing is, we even though we are not in Kamloops, we are everywhere. We have clients in Ontario, Saskatchewan, Manitoba, New Brunswick, everywhere. So we have an online real-time platform where you can onboard end-to-end, do payment for services, do meetings with us online. And we have offices, like Bimpe said earlier, in Northern BC. So we are everywhere. We can serve clients anywhere you have. And you can get us on the phone. You can, send documents to us. We have very robust engagement portal online where you can get across to us, where we can exchange correspondences, documents, and do meetings. So we are available anywhere. We can serve you wherever you are in Canada. I think somebody is raising a Gaba. Can you have the floor now?
Yeah, sorry. I think Mr. Mike already just asked the question as far as how to reach you and the discount for what we're gonna get, what package we're gonna get if we have to reach you to find. The last question I have is what if you had filed before and whoever did the filing did not do it right? How can you make those wrongs right?
We can also, if we will review the file, if it's justifiable to do the refiling, we can do T1 adjustments and make the filing right to correct any mistake there. For example, if they miss a deduction that they should have used, we can do T1 adjustments and we can do that.
Okay, all right, thank you.
That's an excellent question, and I think it speaks to some of us who have probably gone ahead to file our taxes either ourselves or some things might have been missing. So, Mr. Dada, you would the good thing is that FinTax also provide personalized services. Once you consult, they will be able to know, okay, where are the lapses, what can be corrected going forward, and just ensure that we stay within the ambit of the law. I don't have any more questions. And I would just like to say that this meeting is being recorded. So for those of us that are still here, I think we had as many as 25 participants before now. I think people are dropping off gradually because of time. We thank you for your time and would like to say that the meeting is recorded. If you'd like to have the recording, maybe to go over at your own convenience with the permission of the executives of NBCA will be able to share. And then with the directives and as well as the permission as well, we can host some of this information on the website. And just so that our people get all the information, our people get all the values from here, and we can together continue to win and move forward. Thank you for your time, Mr. Dada. I don't think I have any more questions in the chat box. We have posted the contacts and probably your last words on this so that we can have a great day.
Just want to say thank you to everyone that came in here. We are not taking that for granted. We are grateful for coming to listen to us, and we look forward to your future or immediate patronage. And beyond tax season as well, we do corporate taxes, corporate year end, we do bookkeeping, we do tax planning, we do estate planning, we do live business plan. We also do advisory on business acquisition and due diligence that relates to that. So we are a one-stop shop for tax and management and business consulting. And so I say thank you once again. I really appreciate your time.
Thank you. Thanks, everyone, and have a great weekend.
Thank you, everyone.
Bye-bye.
Bye-bye.
Well done, sir, bro, Mr. Olorunke.
Uncle, am I on to Pastor? Is it Pastor?
Yes, sir.